Welcome back to Iraqi Dinar Updates. Say your go-to place for not only updates on the Iraqi Dinar but also insights into global markets and financial shifts that affect us all. Today, we're diving deep into what's coming up in the stock market, from central bank decisions to major earnings reports, global economic shifts, and key events that traders and investors around the world are watching closely. Whether you're just dipping your toes into the market or you're a seasoned investor, staying ahead of the curve is key, and that's exactly what we're here to do today. As we move into June and approach mid-2025, market watchers are especially alert because several critical events are converging, events that could bring volatility, new opportunities, or both. First up, we can't talk about upcoming stock market movements without mentioning central banks. The Federal Reserve in the United States is gearing up for its next meeting, and all eyes are on what the Fed chair will say about interest rates. Inflation has cooled somewhat compared to last year, but not quite to the target level. The labor market remains strong, but signs of slowing consumer spending and softer corporate earnings are making things complicated. Markets are pricing in a potential rate cut later in the year. But if the Fed signals a delay or a more cautious approach, that could send ripples through not only U.S. markets but globally, especially in emerging markets. At the same time, the European Central Bank is expected to announce its rate decision soon. Inflation in the Eurozone has been more persistent than many had hoped. Energy prices are stabilizing, but food and services inflation are proving sticky. Investors will be looking for any dovish tone from the ECB, which could lead to a boost in European stocks and possibly weaken the euro, making European exports more competitive. This kind of movement might also encourage more foreign capital inflows into European equities. Meanwhile, over in Asia, China's stock markets soar under the microscope. There's growing pressure on the Chinese government to stimulate its economy. The property sector is still struggling. Youth unemployment remains high, and global demand for Chinese exports has softened. Any announcement of stimulus packages or major reforms, such as monetary easing, fiscal support, or changes to capital market policies, could inject some optimism into not just Chinese equities but also commodities markets that are tied closely to China's industrial growth. For example, copper and steel might see upticks, which could impact mining stocks globally. One of the most anticipated parts of the market calendar is always earnings season. Over the next few weeks, we're going to hear from some of the biggest companies in tech, banking, and retail. Big names like Apple, Microsoft, Amazon, and Tesla will be releasing their quarterly results. These earnings reports not only affect their individual stock prices but often shape investor sentiment across the whole market. For example, if Amazon reports strong consumer demand and revenue growth, that can boost confidence in the health of the broader economy. On the other hand, if Microsoft reports weak enterprise spending, it might signal that businesses are tightening budgets, a possible red flag for the economy. Banks like JP Chase, Goldman Sachs, and Bank of America will also be in the spotlight. Their earnings can reveal a lot about the economy's underlying strength, especially when it comes to lending activity, credit quality, and capital reserves. Investors will be watching for any signs of loan delinquencies rising or consumer credit tightening. If banks start getting cautious, that's often a sign that trouble could be brewing, especially in the small business or housing sectors. Speaking of housing, the real estate market in the US and parts of Europe continues to be in transition. Rising interest rates over the past year have made mortgages more expensive, slowing down home sales and putting pressure on real estate stocks. However, if we start to see interest rates flatten or decline, this could bring some life back into housing markets, which would in turn affect construction companies, home improvement retailers, and real estate investment trusts. Geopolitical risk is another major theme that traders are factoring into their decision-making. The ongoing tensions between the U.S. and China over trade, technology, and military movements in the South China Sea continue to raise concerns. At the same time, developments in the Russia-Ukraine conflict still pose risks to European energy markets and global food supply chains. Investors hate uncertainty, and any unexpected escalation or diplomatic resolution can cause rapid shifts in market sentiment. One specific event that could move markets significantly is the upcoming G20 summit. World leaders will be discussing global economic cooperation, climate change, and trade relationships. Sometimes, major policy announcements or even informal agreements that come out of these meetings can surprise the markets. Keep an eye on any new trade deals or currency-related statements that could impact currency exchange rates, commodities, and multinational corporations. There's also the tech sector buzz around AI, quantum computing, and semiconductor innovation. Nvidia, AMD, and Intel are not just chip companies anymore. They're at the heart of the next wave of technological transformation. Investors are keeping close tabs on product announcements, regulatory scrutiny, and government subsidies in this space. The U.S. CHIPS Act and similar programs in Europe and Asia are funneling billions into domestic manufacturing, which could create new winners and losers in the global semiconductor supply chain. That's why stock prices in this sector are extra sensitive right now. Let's not forget about energy markets. Oil prices have been volatile due to OPEC+ decisions, unexpected supply disruptions, and shifting demand forecasts. With hurricane season approaching in the Gulf of Mexico and ongoing tension in oil-producing nations, any disruption could send crude oil prices soaring. That would directly affect the stock prices of companies like ExxonMobil, Chevron, and BP, and indirectly affect inflation data and central bank decisions. Renewable energy stocks also remain in play as governments around the world continue to push for cleaner alternatives and expand tax incentives for solar, wind, and battery storage industries. On the commodities side, gold and silver have been making moves lately. With inflation still a topic of concern and central bank digital currencies becoming more than just theory, precious metals are being viewed once again as safe haven assets. If market volatility rises or if there's a sharp correction, gold could surge as investors seek safety. This would also benefit gold mining companies and ETFs tied to precious metals. Another interesting area to watch is the IPO market. While it slowed down dramatically in the past 2 years, there are some big names preparing to go public. Market sentiment around IPOs often reflects the risk appetite of investors. If we see successful offerings, companies pricing high and holding their value, that could boost confidence in growth stocks. But if major IPOs flop, it could reinforce caution and trigger pullbacks in speculative sectors. Then there's the crypto influence. While not directly tied to the stock market, Bitcoin and Ethereum are now closely watched by institutional investors. Their correlation with tech stocks like Coinbase or even broader indices like the Nasdaq has grown. Regulatory clarity is improving in some regions, and if the US SEC finally approves spot Bitcoin ETFs, that could open the floodgates to mainstream institutional money entering the space, affecting both crypto and related equities. Investor sentiment in general will be influenced by upcoming economic data, particularly U.S. non-farm payrolls, CPI, Consumer Price Index, and PMI, Purchasing Managers Index, reports. Each one of these releases gives a snapshot of the economy's health and has the power to shift markets. Strong job growth and low inflation might be seen as a Goldilocks scenario, encouraging equity buying. But if inflation comes in hot or job numbers disappoint, expect volatility to spike. Finally, political developments in the U.S. and Europe are starting to matter more as we head toward major elections in 2026. Policy shifts around taxes, spending, healthcare, and defense can all affect different sectors of the market. Markets are already pricing in some of the uncertainty, but the closer we get to elections, the more headlines will move stocks, especially those in defense, healthcare, and infrastructure sectors. So, What does this all mean for investors and traders? It means the next few weeks and months are going to be packed with potential both for gains and for caution. Being informed is your first line of defense. This is not the time to make decisions based on hype or fear. It's the time to stay grounded, keep your eyes on the macro and micro developments, and adjust your strategy with discipline. And that brings us to the end of today's update. We've talked about central banks, earnings seasons, geopolitical tensions, commodities, crypto, and all the moving parts that shape the market. Whether you're investing in U.S. stocks, watching the Asian markets, or simply keeping tabs on how these shifts impact currencies like the Iraqi dinar, knowledge is power. If you found this video helpful, don't forget to like, subscribe, and tap that bell icon so you never miss an update from Iraqi Dinar Updates. Let us know in the comments what you're watching in the market or if there's a specific topic you'd like us to cover in the next episode. Until next time, stay informed, stay cautious, and as always stay empowered.